Memory chips were, for decades, the worst business in technology. A boring commodity. Brutally cyclical. The first thing to crash in every downturn. And then, last quarter, the largest US maker of memory did something that has never happened. It turned that commodity into the most profitable business in semiconductors, a gross margin of about 85%, higher than Nvidia's. Revenue grew 346% to $41.5 billion in a single quarter. That company is Micron, the only US-listed memory maker. So what changed? Is it real, and why, after a huge run, does the stock still trade like the crash is coming? Let's run the numbers. To see why this is shocking, you have to understand how bad this business used to be. Micron makes memory, DRAM, the fast-working memory in every computer, and NAND, the flash storage in every phone and drive. These are commodities. Interchangeable, sold by the bit, priced by supply and demand. And the cycle was vicious. Whenever prices rose, everyone built more factories, flooded the market, and prices collapsed, often below the cost to make them. Micron has lost money in entire years. For 30 years, memory was the textbook boom and bust business. That history is exactly why what just happened is so hard to believe, and why the market still doesn't fully trust it. So what broke the pattern? 3 letters, HBM, high bandwidth memory, is the specialized, stacked memory that sits right next to every AI accelerator. Every Nvidia and every rival AI chip needs a wall of it. And unlike commodity memory, it is hard to make, supply-constrained, and priced at a steep premium. Look at what it did to Micron's data center memory. A year ago, that business ran a 38% gross margin. Last quarter, 87%. Same factories, a completely different product mix. And the demand isn't a spike. Micron says HBM is sold out, fully booked, well beyond 2027, into 2028. The AI build-out needs more memory than the entire industry can make. So let's put the quarter on the table, because it is historic. Revenue, $41.5 billion, up 346% from a year ago, and up 74% from the prior quarter alone. Net income, about $28 billion in 3 months. Earnings per share, just over $25. Operating cash flow, $25 billion. And the guidance went higher still. Micron expects about $50 billion next quarter, at an 86% gross margin. For a company that used to lose money in bad years, these are numbers without precedent in memory history. If you're tracking who actually wins the AI build-out, subscribe. Next we go up the stack to CrowdStrike, the company securing all of it. Where is all of this coming from? Almost entirely one place. Micron now reports in business units, and 2 of them are pure AI. Cloud memory did $13.8 billion last quarter, up from $3.4 billion a year ago. Core data center did $11.5 billion, up from $1.5 billion. Together, those 2 AI units are about $25 billion, roughly 60% of the entire company. A year ago they were a fraction of that. The phone and the car businesses still exist, and they're growing too. But make no mistake, Micron is now, first and foremost, an AI infrastructure company that happens to make memory. The data center is the engine. Now the trillion-dollar question, literally. Has memory finally broken its cycle? Micron's answer is a new weapon, strategic customer agreements. These are take-or-pay contracts. Customers commit, in writing, to purchase specific volumes for years, whether they need them or not. The scale is staggering. 14 of these deals carry about $100 billion of revenue at minimum price over their terms, and they bring $22 billion in upfront cash deposits. Management expects about half of revenue to sit under these agreements. That is the bull case in one move: turn a boom-bust commodity into something that looks like a subscription. If it holds, memory stops being a casino and becomes an annuity. Why can Micron even charge these prices? Because there are only 3 of them. After 30 years of brutal consolidation, the entire world's DRAM is made by just 3 companies, Samsung and SK Hynix of Korea, and Micron. That's it. 3 players, and the 2 leaders are disciplined. In HBM specifically, SK Hynix leads with about 62% share as Nvidia's lead supplier. Micron is now number 2, around 21%, having just passed Samsung. That structure is the real moat. A 3-player market with rational supply behaves nothing like the 20-player free-for-all of the 1990s. Consolidation is the quiet reason these margins can even exist. Let's lay out the field. At the top of overall memory, Samsung, the giant, number 1 in total bits. Then SK Hynix, the HBM leader and Nvidia's key partner. Then Micron, number 3 in DRAM overall, but number 2 in the HBM that matters most, and the only one listed in the United States. Below the big 3, Kioxia and SanDisk in NAND flash, and China's rising challengers, CXMT in DRAM, WMTC in NAND, the long-term wildcard. But for the leading-edge memory the AI boom actually needs, it comes down to the same 3 names. And of those 3, Micron is the only way a US investor owns the memory shortage directly. Now the strangest part of the whole story, the valuation. After the report, Micron surged. The market cap is pushing toward $1 trillion. And yet, even after that run, the stock trades at only about 11 times forward earnings. 11. The average semiconductor stock trades near 30. So the most profitable memory quarter in history, growing 300%, is valued at a third of its peers. Why? Because the market has been burned before. That low multiple is not a bargain signal, it's a vote. Investors are saying they do not believe an 85% margin survives. The whole debate is in that number, either it's the cheapest AI stock on the market, or it's correctly priced for the cycle to turn. Let's put it together. On one side, an 85% gross margin, higher than Nvidia's. Revenue up 346%. HBM sold out past 2027. About $100 billion of take-or-pay contracts. A 3-player oligopoly. And only 11 times forward earnings. On the other side, it is still memory, the most cyclical commodity in technology, where every single peak in history has ended in a glut. That 11 times multiple is the market betting the normalization is coming, the only question is when. The franchise says the cycle broke. The multiple says don't be so sure. So where do I land? In my view, something genuinely structural has changed. The 3-player oligopoly is real, HBM demand is real, and take-or-pay contracts are a real attempt to break the cycle. This is not the memory market of the 1990s. The supercycle is earned, not imagined. But I would respect the word cycle with everything I have. Memory has humbled every investor who declared the cycle dead, and they declared it dead at every prior peak too. The 11 times multiple isn't stupidity, it's scar tissue. My read, enjoy the boom, watch the supply discipline like a hawk, and remember that the bigger the peak, the bigger the air pocket if it ever turns. The margins are extraordinary. Whether they're permanent is the entire bet. My base case for the next 12 to 18 months, HBM stays sold out, margins stay near record, and the stock trades on one question: is the cycle really dead? Watch 4 signals. First, the HBM sold-out horizon. Booked beyond 2027 today. If it extends further, demand is winning. If it pulls in, that's the first crack. Second, gross margin. About 85%, guided to 86%. As long as it holds above 80%, the cycle break thesis lives, the first sequential drop is the tell. Third, the take-or-pay coverage. 14 deals, roughly $100 billion, half of revenue. More coverage means more durability. Fourth, supply discipline. Watch all 3 players' capacity plans. If anyone breaks ranks and floods capacity, that is the classic trigger for the next bust. Upstream, Micron depends on chip-making tools and leading-edge nodes. Downstream, it sits inside every AI server on Earth. The catalyst that lifts it, the shortage running for years. The one that breaks it, the word that has broken memory every time before, cycle. Micron just turned the most boring commodity in technology into the most profitable business in semiconductors, an 85% margin, higher than Nvidia, on revenue up 346%. The engine is HBM, sold out past 2027, lifting data center margins from 38% to 87%. The new weapon is $100 billion of take-or-pay contracts trying to turn a casino into an annuity. And it's the only US-listed way to own the memory shortage. The catch is the oldest word in this industry, cycle, and an 11 times multiple that says the market still doesn't believe. The bull case is that memory finally broke its cycle. The bear case is that it never has before. One stock, all the numbers, no hype. I'm Big Z, follow me, see you in the next deep dive.